You get to the end here, you can see your profit after tax, before and after tax. So total profit before, and then the tax, and then after. But notice that that is the value that comes to the reconciliation section. And then this is where really the reconciliation section is calculating the difference between the accounting profit and the tax profit. So we know that there's things that are not deductible. We know the entertainment is not deductible, and we tagged it accordingly, and it's treated as such. Our temporary full expensing, often depreciation is treated as non-deductible from the accounting side, and then later treated as deductible from the tax side. But certainly in this case, you could see the superannuation payable is automatically treated as non-deductible. So the superannuation liability, 30 June 2020, okay, so we're 21 and 22. Let me change that so it's more meaningful, and that's why we couldn't see it properly before. There's that government rebate, sorry. But anyway, back to the balance sheet, just to show you that liability for super, so 9,800 is not deductible because it wasn't paid at the end of this year. And the 5,000 is now deductible because it would have been paid during the 22 financial year. Back over to that company tax return, looking in the reconciliation section, and we've got our non-deductibles. So the super is non-deductible, and the super from the prior year is now deductible as other deductibles. Other income not included in the assessable income, decrease in interest, and the government rebate. Now notice with the government rebate, we tagged that as non-assessable, but the interest, we do need to report interest manually. So if you don't do this, you will get an adjusting entry, and you'll have either an increasing or decreasing adjustment, where if the taxable value is greater than the accounting value, then you'll have an increase in reportable interest in the reconciliation. And this will be this will be the case in the case of dividends, trust distributions, partnership share. So back over here, let's have a look at that interest. Now we've got an increasing adjustment for our interest, but it is possible that your taxable value was different to the accounting value. This is more likely to be the case with your dividends, trust income, and partnership. So let's just put that down to 32. And now we've got a decreasing adjustment, which is where the reconciliation will come into its own and take out that adjustment for you. So it's all automated at a reconciliation standpoint, automating the differences that arise between the accounting facts and the tax facts. But certainly you saw there how that classification comes into its own with the tags. So back over here and tags, and you saw me playing around with those tags and the tags over here. Look, 9 times out of 10, you never need to worry about using the tags, but if you do, this is how you use them.